The stock market we know today has a long and fascinating history. It is a story of evolution, innovation, and adaptation that spans centuries and continents. Its roots lie in the earliest forms of trade, where human ingenuity first began to shape the economic landscape. Long before money or stock exchanges, people exchanged goods and services through bartering. This was a simple yet effective way to meet mutual needs. Barter systems relied on mutual needs and direct exchange. For instance, a farmer with surplus grain could trade with a blacksmith who had extra tools.
A farmer might trade grain for tools from a blacksmith. This system had limitations, such as the difficulty in finding someone who had what you needed and wanted what you had. It was difficult to establish a fair value for different goods. The value of items was subjective and could vary greatly depending on the situation and the individuals involved. Finding willing traders could also be challenging. Markets were not always bustling, and the right trade partner might not be available when needed.
As trade expanded, so did the need for more sophisticated systems. The limitations of barter led to the development of new methods to facilitate trade. Out of this need, credit emerged. Credit allowed traders to exchange goods and services without immediate payment, paving the way for more complex economic interactions. Credit allowed for delayed payment and facilitated more complex transactions. Merchants could now trade on the promise of future payment, which expanded their trading possibilities. Merchants began issuing informal IOUs. These were simple written promises to pay a certain amount at a later date. These IOUs were early promises to pay at a later date. They represented trust and a commitment to honor one's word in future transactions. This system allowed merchants to conduct business across distances and time. They could trade with partners far away, knowing that their credit would be honored. It fostered greater trust and flexibility in trading relationships. Merchants could build long-term partnerships based on mutual trust and creditworthiness.
However, informal credit systems had their drawbacks. Trust was essential, and disputes could easily arise if one party failed to honor their commitment. Disputes could arise over the terms of repayment. Without standardized agreements, misunderstandings and disagreements were common. The lack of standardization made it difficult to transfer credit between parties. Each agreement was unique, making it hard to establish a consistent system. These limitations paved the way for more formal systems of finance and eventually the birth of the stock market. The need for reliable and standardized financial instruments became apparent.
The journey from bartering to credit was a significant milestone in economic history. It marked the beginning of more sophisticated financial systems, laid the groundwork for the complex financial systems we have today. The evolution from simple barter to advanced credit systems reflects human innovation and the continuous quest for better ways to trade and manage resources. During the late Middle Ages, a new financial instrument emerged, the promissory note. This simple piece of paper would go on to revolutionize the way business was conducted, laying the groundwork for the complex financial systems we have today. This marked a significant step towards modern stock markets. Before the advent of promissory notes, trade and investment were limited by the need for physical currency and the inherent risks of transporting large sums of money. Promissory notes were written promises to pay a specific amount of money on a specific date. These notes were transferable, meaning they could be passed from one person to another, much like modern-day checks or bonds. This meant that they could be used as a form of payment or sold to another party. The flexibility and security provided by promissory notes made them an attractive option for merchants and traders.
This transferability opened up new possibilities for investment and trade. Merchants could now engage in transactions without the immediate exchange of physical money, reducing the risk of theft and loss. Merchants and investors began to see the potential of promissory notes. They realized that these notes could be used not just for individual transactions, but as a means to fund larger ventures. They realized that these notes could represent shares in a venture. This was a groundbreaking concept, as it allowed for the pooling of resources and the sharing of both risks and rewards. For example, a group of investors could finance a trading expedition by each contributing a sum of money in exchange for promissory notes. These notes would then entitle the holders to a share of the profits from the expedition, The profits from the expedition would then be divided among the note holders in proportion to their investment. This system allowed for greater financial collaboration and the undertaking of more ambitious projects. This system allowed individuals to pool their resources and share the risks and rewards of ventures. It was a precursor to the modern concept of stock ownership and investment.
These early forms of stock trading were initially informal. They often took place in coffee houses and taverns where merchants and investors would gather to discuss business and trade notes. They often took place in coffee houses and taverns. These establishments became the hubs of financial activity where the latest news and opportunities were shared. These informal gatherings served as early trading floors. The lively atmosphere of these venues facilitated the exchange of information and the negotiation of deals. Merchants and investors would meet to buy and sell promissory notes and shares in various ventures. This practice laid the foundation for the more structured and regulated stock exchanges that would follow.
As the volume of trading increased, so did the need for a more organized and regulated marketplace. The informal nature of coffeehouse trading could no longer support the growing complexity and scale of financial transactions. This need led to the establishment of the first official stock exchanges. These institutions provided a formal setting for the buying and selling of stocks and promissory notes, ensuring greater transparency and security. The world was on the cusp of a financial revolution. The establishment of stock exchanges marked the beginning of a new era in finance, one that would see the rise of global trade and investment on an unprecedented scale.
The 17th century witnessed a pivotal development in the history of finance, the establishment of organized stock exchanges. Among the earliest and most influential was the Amsterdam Stock Exchange, founded in 1602. The Amsterdam Bourse, as it was known, provided a dedicated marketplace for trading shares in joint stock companies, particularly those involved in the booming Dutch East India Company.
The exchange operated on a system of auctions and brokers. Brokers acted as intermediaries, connecting buyers and sellers for a commission. This formalized approach brought greater transparency and efficiency to stock trading. The Amsterdam Bourse became a model for other exchanges that sprang up across Europe. Its success fueled the growth of international trade and investment.
The establishment of formal stock exchanges marked a turning point in financial history. It signified a growing recognition of the importance of capital markets in facilitating economic growth. These exchanges provided a platform for companies to raise capital for expansion and innovation. They also gave investors a means to participate in the wealth generated by these companies, fostering a more interconnected and dynamic global economy. The early 18th century witnessed both the promise and peril of financial markets with the infamous South Sea Bubble. This period was marked by a frenzy of investment and speculation, driven by the allure of untold wealth and the rapid expansion of global trade routes. The South Sea Company, a British joint stock company, was granted a monopoly on trade with South America. This monopoly was seen as a golden opportunity, promising vast profits from the untapped resources and lucrative trade routes of the New World. Fueled by speculation and rumors of vast riches, the company's stock price soared to astronomical heights. Investors from all walks of life were drawn in, hoping to make their fortunes overnight. The excitement was palpable and the financial district buzzed with activity as more and more people bought into the dream.
Investors, eager to cash in on the perceived bonanza, poured their savings into the company. The frenzy was such that even those with little understanding of the market were swept up in the excitement, convinced that the South Sea Company was a sure bet. However, the South Sea Company's ventures in South America proved far less lucrative than anticipated. The grand promises of wealth and prosperity were not realized, and the company's actual trade operations fell short of expectations. The reality of the situation began to set in, and doubts started to creep into the minds of investors. When the bubble burst in 1720, it triggered a financial panic. The sudden collapse of the stock price sent shockwaves through the market, and the once celebratory atmosphere turned to one of fear and desperation. Investors scrambled to sell their shares, but it was too late for many. Share prices plummeted, leaving countless investors bankrupt. The financial ruin was widespread, affecting not just the wealthy but also ordinary people who had invested their life savings. The impact of the crash was felt across the entire economy. leading to a period of economic hardship and uncertainty.
The South Sea Bubble serves as a cautionary tale about the dangers of unchecked speculation and irrational exuberance in financial markets. It highlights the risks of investing based on hype and rumors rather than solid financial fundamentals. The South Sea Bubble had a profound impact on financial regulation. The scale of the disaster prompted a re-evaluation of how financial markets were governed and the need for greater oversight to prevent such a catastrophe from happening again. The British government passed the Bubble Act of 1720, which sought to restrict the formation of joint stock companies and curb speculative trading. This legislation was an attempt to bring order to the chaotic financial environment and protect investors from future bubbles. While the act was later repealed, it reflected a growing awareness of the need for some form of oversight to protect investors and maintain market stability. The lessons learned from the South Sea Bubble would resonate through the century, influencing the development of financial regulations and market practices.
The lessons learned from the South Sea Bubble would shape the development of financial markets for centuries to come. It serves as a reminder of the importance of due diligence, the dangers of herd mentality, and the need for regulatory frameworks to ensure the stability and integrity of financial systems.